Let's get you more perspective now on this bank failure. Joining me is Anthony Chan. He's the former Chief Economist at JPMorgan Chase. Anthony, thanks so much for taking some time out from your weekend. News of this stunned a lot of people. This is a highly respected institution. It's the second largest bank collapse in U.S. history, and it happened in less than 48 hours. Can you explain what the catalyst was? How did things go so wrong for the bank so quickly?
Well, you got to realize that when a bank has their deposits concentrated in one sector, they're vulnerable. When a bank has a situation where they're buying securities, in this case, treasury securities and mortgage-backed securities, in order to make money from their deposits that have a short duration and the securities have a long duration, there is risk if the Federal Reserve starts raising interest rates very rapidly. And finally, you have a situation where the startup industry was not borrowing as much, so there's risk on their loans. So you basically had the perfect storm in this situation. And what happened was that they ended up losing money on their loan portfolio, and naturally they tried to raise capital to make up for that gap. But once the information got out that they were in trouble, everybody ran for the exits.
Yeah, we haven't seen anything like this since the financial crisis of 2008. So the FDIC, bank regulators, had to step in very quickly because of the huge run. But how long before those who couldn't get their money out will be able to do so? And will they be fully paid?
Well, I think that right now the FDIC is working as hard as it can to make sure that most people will be made whole, hopefully more than most people. They're also probably going to be looking very hard to find a buyer. And if that's the case, then more people can be made whole. But there is still uncertainty. But until Monday, when the FDIC has vowed to open up the bank and allow people to move those funds, the people that didn't get a chance to before they closed on the bank will be a bit concerned. And the concern is warranted. But again, not indicative of a systemic problem for the entire banking system, even though we know whenever you have concentration, whether it's deposits or of other natures, that does increase risk. And when interest rates rise this rapidly, that magnifies the risk.
At the moment, there doesn't seem to be thought of any contagion, but what could the wider implications be for the banking industry? Could this start to be the first real sign of some cracks? And do banks start tightening lending and credit facilities even more as the Fed continues to really turn the screws by raising interest rates to bring down inflation? We're going to see them probably do that again at the end of this month.
Ironically, Karina, one of the problems for this bank was that there was not enough lending, and they had to resort to basically buying these securities, which, as you know, lose their value as interest rates rise. If they would have had more lending in areas that wouldn't have caused any problems with their loan quality, and they wouldn't have had to get these securities that lost a value of about $1.8 billion, and then requiring them to raise more money, problems wouldn't have occurred. So again, the concentration is the major problem. And what we could see now is investors starting to look at banks that have concentration, and maybe that will lead to a little bit more diversification out there. So again, this is a problem for SVB, but the hope and expectation is that the market and investors will send a strong message to financial institutions to promote more diversification so that these problems don't develop in the future.
Yeah, it will be very interesting to see what happens to bank stocks come Monday morning. Anthony Chan, thank you so much for your time today.
Pleasure.